Welcome everyone to Frank Finance, where you can get your honest financial information and your questions answered. Today is the second part of my four-part series video, where I will go over the lay of the land of personal finance, and as mentioned in a prior video, first we need to understand our budget, which I talked about in the last video. Now we're on to talking about our debt. In the next future two videos, we'll be talking about investments and net worth planning. All right, so debt is the ability for an individual to take money out from a lender. In return, typically you owe a thing called interest on top of the amount that you owe. So if you borrow $1,000, you might actually owe $1,200 at the end of the term. The difference is the interest that the lender is owed for giving you the money, or also referred to as the time value of money. So debt really can be thought about in a couple different lines. So student loans, credit cards, car loans, home mortgage. And why do I think about them all differently? Well, each one of them have their own tax advantages or they have their own downsides. So for instance, credit card debt. The average American debt right now is about $6,000, and almost 50% of Americans don't pay off that balance every single month, which means they're subject to credit card debt. And in a few minutes, I will talk through what does that mean, what does it look like, and how do you understand credit card debt. Student loan debt. So student loan debt is actually a debt that is a tax deduction. So for instance, if your federal tax rate is 20%, all of the interest that gets paid on student loan debt is actually tax deductible. So all the interest that you accumulate, you can't take the total sum of it and say, well, that is what I lost by not paying this off early. In fact, you can only take about 80% of it, which I'll talk about in a little bit. Now, car debt. So car debt is there's no real tax deductions on car debt unless you buy a Tesla, which is for a whole nother topic, but which is more of a environmental credit that you can get through taxes. But if you talk just straight going to the dealership and buying a car, it's really the faster you pay it off, the faster that you ultimately pay less in the long haul. Assuming, of course, that you have the cash flow to pay it off early. Which the idea of paying off car debt is great, but that really has to fit into your budget. You really have to have the ability to reduce the debt through extreme payments to your car loan, and we'll get into that in a second here to really see what does that mean. And then ultimately your home debt. That one I think I need to do another full topic video on, but from home debt perspective, the thing that you need to keep in mind is that when you buy a house, the first couple years of buying a home, the majority of your payment that you pay is actually interest. And that's intense. And I'll talk a few topics about that real briefly here shortly, but ultimately the amount that you put in interest towards a home is actually considered a tax deduction to build up to an itemized deduction. That I need to really go into depth in another video, but just keep in mind that every one of these debt obligations that I'm talking about here for personal finance really need to be considered separately because they all have different impacts on whether or not it makes sense to dump all of your cash flow on it versus maybe investing or actually just building up your nest egg or your oh crap fund, if you will. So what I'm going to do here, just like the previous videos, I'm going to bring up a spreadsheet and talk through it. All right. So what you have in front of you here is a spreadsheet where we're going to talk through two of the key items here, and then I'll bring up an amortization schedule on the other two items. So first and foremost, credit card. So a credit card, on average, as I mentioned, about $6,000 is what the average debt is per credit card. And the average annual percentage yield is 20%. So I just inputted these two items. And mind you, all these items are flowing through an amortization schedule to build up these amounts. And also on a side topic, Everything that you're seeing here on this video is going to be in the link below with the Discord link. Inside of my Discord, there's going to be a hashtag finance files. That will be where you can get a hold of my budget file, my debt file, and the future net worth and investment files. They will all be in here for your disposal if you want to use them. Most of these things you could fill out yourself, but if you like how it's set up and you want to use it, go right ahead. Come to my Discord. It's free, and use this file to your advantage. And if you have questions, I always ask. I will help set these up for anyone that has questions. So from a credit card perspective, I have this set up to talk through and put in your APY and your base, because everyone's could be different. Everyone's situation's different. And then the point of this is to look at over the next year, because credit card debt really is short-term debt. It's not really long-term debt. So how do you think about over the next 12 months? And as I think of this individual, let's say this individual's got $6,000 in debt on a 20% APY. That means on a monthly basis, they have 1.7% in interest that grows on that base every single month. Let's say that they're not able to make the full payments, but they want to make the minimum payment that's due, which typically is either 1% of what is the balance, so 1% of $6,000 or $25, whichever is greater. So in this instance, since it's greater than $2,500, which is 1%, to get to the $25, you would owe a minimum payment of $60. Now, if you pay only $60, mind you, the interest rate per month is worth $100. So basically, you can see the math here that every single month, all you do is make the minimum payment. You're actually going in the hole $40 more. Now, that could be good or bad. If you're in a tough time and you say, you know what, I'll make the minimum payment. I can't make more than that. I'm only losing $40 a month. That's fine. You can't treat all debt as bad. You have to take it situational and understand your own personal finance on this and know does it make sense to dip into your reserve to pay it off. If you're a Dave Ramsey fan, you know that you should pay off all debt as fast as possible. But we've all been there where we maybe don't have the cash to do that, and you just need to understand what does it mean if you maybe don't put all your money towards your credit card up front. So for instance, this one right here is talking through the credit card that says if you were to pay just the minimum payment of 1% on a 6,000 base with 20% APY, what happens after the course of 1 year? Well, you make a total payment of $750 and you actually go $500 deeper into debt. So if you think about that, you pay $750 and your debt increases by $650, so you actually have a net reduction of just short of $1,500 where you basically it's gone. It'll never come back. And so for this instance, the thing to just keep in mind is that it's not always bad to pay the minimum payment. Sometimes that's all you have, and to be honest, you have to make the minimum payment because it will impact your credit score if you don't. That is considered a missed payment if you don't pay the minimum payment. So in this instance, this is more educational to try to talk through if you only pay the minimum payment, what does that look like, and how bad does credit card debt actually add up. So now let's just double this for a second for fun. Let's change this to $10,000. Well, let's do $12,000. So $12,000, just as the math works, it's doubled basically. Now you're required to pay $120 a month minimum payments. The interest now is worth $200 a month, which means you go in the whole $80 versus $40 in the old scenario. And it ultimately lands at a base of $13,000 at the end of the year, while you actually paid $1,200 towards the credit card. So not only did you give up $1,200 to them, but then you also added $1,000 to your debt, which means now you're $2,200 further away from the goal of being debt free. So take the information as you will. Every scenario is different. I personally will always pay my credit card off every month. I love credit cards in the essence that they give me 1.5% cash back. And so for me, it's like a little bonus every single month that I get in regards to this. So I put everything that I can on a credit card and I pay it off every single month. Um, the one scenario that I will say that's really unique with credit cards, which I'll do another video on, but I will do a teaser on, is if you're ever to do a large payment, sometimes getting and opening a new credit card is very beautiful. And what I mean by that is when me and Carly were paying for our wedding, I actually opened up a new credit card that allowed me to have $15,000 at 0% for 18 months. So I was able to have a zero cash flow impact for the most part on $15,000 for 18 months, a very minimal impact. So I didn't have to give up my money. So there is ways to use credit cards if you're very disciplined. I would highly not recommend this if you're not disciplined, but there is very sweet ways to use credit cards to your advantage. Um, and that's one example is if you're to make a big purchase and you find a credit card to open that's going to give you a large sum for a large amount of months with a 0% APY, there's a very good way to finance yourself versus going through a bank. Um, but I'll talk about that in another video. Just keep that in mind. It is a sweet way to help bridge a gap so that you can maintain your nest egg at where it's at today. All right, so that's all I'll talk about with credit cards. Obviously, they're very detrimental, and you can see how the higher the base, the worse it obviously gets. So the next item I really want to talk about are student loans, because this, I think, everyone for the most part that goes to college, has to think about. All right, so student loans. I have a small example here to really talk through student loans, and mind you, this is very situational and needs to be applied to your own situation. Everything that's behind this document, there's an amortization schedule that runs off of the annual rate and runs off of the base amount. So if you use this document, all you have to do is enter in those two gray boxes here, and you will ultimately be able to have this cycle built for you. And this is assuming you make the payment that's required, of course. So now, what does this mean here? So student loans. Student loans are unique in that the interest that you pay on student loans are actually tax deductible. So keep that in mind when we're going through this, and remember that if you make less than $85,000 a year, you're actually able to deduct the interest that you pay on these student loans against your taxable income. And for the purpose of this example here, just so you know, I'm using the 22% bracket, or formerly known as the 25% bracket before the tax cuts that came into effect last year. So just keep that in mind. This is for 2020's use in taxes. So if I use the person with a base of $25,000 in student loan debt and a bracket tax bracket rate of 22% and an annual rate of that loan of 3%, what does that mean? Well, what does that mean is that over the course of 10 years, which is the average that you'd pay over your student loans, you would actually pay interest of nearly $4,000, while you would be able to deduct nearly $875 of that to net you to about $3,100 in actual interest that is owed to the lender on top of your principal that you owe. And so when you're thinking about debt planning, you really have to think about what is my opportunity if I pay off the debt early. So what I have down here on the bottom is a payoff cycle to say, what happens if you pay it off in year 2? Well, you would have $25,000 in payments. You would have interest net of tax of $1,000, and you would have a total obligation to the lender of $26,000, which would mean if you found a way to pay off early, this would save you $2,000 if you could pay it off at the end of year 2. So 24 months, you pay off the entire $24,000 or $25,000, you would save yourself $2,000. Now, what's really important is that if you don't make payments early, what this actually does. So in year 3, you only save $1,500. In year 5, you only save $800. And in year 8, you only save $100. So the real question for yourself is, outside of peace of mind that the debt is paid off, after about 5 years, you're not going to really save anything to put all your money on your student loans. If you have the cash to pay it off, that's great, and you should. Um, I'm a firm believer in paying off your debt as fast as possible, but you need to understand that paying it off doesn't net you anything. It doesn't give you really a lot of cash back. So unless you're able to aggressively pay it off in less than, call it, 3 years or 4 years maximum, in this instance for student loans, paying them off, it sometimes might make sense to wait and build up your cash flow. Enjoy life while you're young, because you're never going to be able to get that back. But this, again, is just informational purpose so that you can look at it and say, what is it worth? What is it actually worth? What is the opportunity? If I throw all my cash on it, what does it do? And that's what you really need to understand when you're trying to plan your own budget, is what's the opportunity and what's the risk. To me, I would rather pay the monthly payment until I have a lump sum to dump on it. That's over maybe what my nest egg is that I personally want to hold in cash uh, to feel secure and not worry about money. So that's all on your own personal preference, your own personal risk profile. But this, again, is just to shed information on how this works and how debt works. And in this student loan example, mind you, can be extrapolated across your car loans. It can be extrapolated across your house. The first 50% of the mortgage of your car payments, that's where all the interest comes from. So if you're not putting payments on early and finding a way to do that, you're actually not going to save a lot of money in the long haul. In fact, all you're doing is giving up your cash flow. And if you have a really good nest egg, and that's fine, that's great. Whether it's your 3 month, your 6 month, or your 12 month, you know, oh crap fund, depending on where your threshold is, to me it doesn't make sense to dip into that to save $100 or to save $800 over the course of 5 years. Think about that. That's nothing. It's like a Starbucks per day in savings. It's not material. And maybe to some people it is, but I think if it is material to you, I think paying extra is probably more material than that. So just being aware of what the cost it is to actually have debt is very important. And so this, again, is just a small example of what does it mean if you were to have this amount in debt and this is your rate. And mind you, this document will be in my Discord link below in the hashtag finance files for you to come in here and type in some pieces of information. And if you have questions, I can always walk you through it. So this is all I will talk about on student loans, and hopefully you enjoyed it. Alright, I know that this has been a really long video, but hopefully that this helps you start thinking about debt in different ways. Thinking about, does it make sense to put all of your cash flow towards it? Does it make sense to just wait? And maybe the advantages you might be able to use towards acquiring more debt to maybe help bridge cash flow gaps that you have today. And what does that mean? It's all customizable to your own self. And as always, below will be my Discord link to get the documents that were presented today. I will be doing future videos more in depth on mortgage debt and what does that mean, and maybe even some teasers into credit cards. But also every Sunday night, tune in to my Twitch podcast. Basically, the link is below to my Twitch, and so every Sunday night at 9 p.m. Central Time, right around that time is when I'll go live, and it's open discussion to talk about anything finance. So those are not posted on YouTube, so those are really good times for you to come in and just ask anything related to finance or personal, corporate, taxes, you name it, we'll talk about it. So as always, I made it through my second video. Appreciate it if you listened this long. I hope you have a great rest of your day now. Bye.